today on the Tearsheet Podcast.
And so what we did as the zero interest rate market sort of came undone, raised a lot. The cost of money went up for everyone, right, across the world. We really dialed back on our marketing and extended our runway to deliver two new products that we think, well, at the time would think, and we now can confirm are working synergistically together.
Podcast listeners, this is Zach Miller, Tearsheet Editor-in-Chief, and welcome to another episode of the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. At Tearsheet, we've been following the growth and maturity of neobanks over the past few years, and all in, with the billions of dollars invested, products launched, and customers acquired, the path to good unit economics has been elusive for some. Joining me on this podcast today is Stuart Sopp, CEO and co-founder of Current. And on today's episode, Stuart's going to give us a behind-the-scenes look at how Current has managed to thrive throughout the fintech winter by adjusting the dial on its marketing spend without compromising its growth. Stewart also delivers a masterclass in product development and finding the right product market fit for digital financial products. Sopp will dive into Current's development pipeline and go-to-market strategy behind its new earned wage access and credit builder card, as well as what he's seeing in demand for these new products. It's a conversation about what it takes to build a neobank that doesn't only survive, but thrives. Stuart, welcome back to the show.
Hi, Zach. Thanks for having me again. It's awesome to be here.
It's always great to catch up with you, Stuart, because I find that when we talk, I get such a good view at a macro level, like sort of trends that's happening in the marketplace, as well as micro, what's happening at Current and how your customers are responding. Maybe that's a great place to start. Like, what's new at Current and what changes have you made to adapt to changing market needs in this particular market?
Yeah, it's a great question, and let's see how long you got. There's so much change.
Go.
Yeah, we got time. Yeah, we've seen a lot of change. More specifically, since the middle of last year, sort of June, July, 2023. I think we're on last year. There we go. And so what we did as the zero interest rate market sort of came undone, raised a lot. The cost of money went up for everyone, right, across the world. We really dialed back on our marketing and extended our runway to deliver two new products that we think, well, at the time would think, and we now can confirm are working synergistically together. And that's really built upon our sort of our proprietary technology stack that many listeners will be familiar with probably by now. And so the first one is the Build Card, which is a secured charge card that works in a really interesting way. And then and I'll go into that in a second. And then two, we launched a earned wage access product that works well with the rest of the value and products that we have launched and built on Current over time. And we launched that, I think, internally in October last year, and then started leading and marketing basically at the beginning of this year. And so those are the two big changes. And those were sort of strategic changes for us, one of which was customers. They need our customers are sub 620 FICO customers, deep subprime, many of them sort of not in the business model of banking. They don't really fit it very well because even in aggregate, they don't have a ton of deposits together. And so banks really give them a sort of a terrible deal, right? So there's a lot of fixed fees, overdraft fees. Everyone's very familiar with, that experience now. And banks really it's a rare triple win in the sense that banks, as we acquire customers from them, these customers, that they get stronger on unit economics, we get stronger because we can do it profitably. And then the customers get a great deal, right? So they get liquidity, they get credit building, they get all this other stuff that the banks are really unable, they're not unwilling, but they're unable to deliver to this type of customer. So I'll start maybe with the Build Card. So secure charge card. It's unique to Current in the sense that it is one balance, one ledger. You could imagine competitors using sort of I2C or Galileo or sort of those in between processes that link to the networks. And of course, then they have maybe multiple issuing banks, which has its own, we could probably spend a lot of time talking about that too. Very topical now. And so you could imagine having a debit, credit card, secured charge card, and these are multiple ledgers, multiple issuing banks, different rules and regulations between them all. Very hard to get a really good attach rate and a really succinct nice experience, simplified experience for pretty much everyone else. And so using our own ledger, our own core, we were able to build this unique experience, which is, you can build credit with every swipe when you collateralize the account as little as $1. Obviously, we prefer you to move your paycheck over, because obviously a lot of liquidity then unlocks with that gating action. But yeah, the build card builds credit with every swipe. You're looking at 10 to 20 points within the first month or two. And so it's a great product for the customers, because their debit and their secured credit card are sort of deprecating one balance, right? So you put money in and you can use your debit or credit. There's no moving money around or anything like that. And so we've taken all that complexity on the infrastructure on the product side and really just simplified it and rendered it to like, hey, open a current account. You get these two cards, virtual, then physical, and then you can build credit with every swipe. And so that's a market-leading product attach. We believe, I think, in the markets. That's great. So customers who are sort of sub 620 FICO score, one of their main problems is their credit score, right? And they know that access to liquidity or credit is being hampered by either thin file, no file, or some form of an event, or they're out of the check system. They're in the check system or whatever. And so banks are unable to service them. So this is like an amazing product for them to really fall back into and start getting that good behavior going. And then building that credit score. It benefits the company for us is because we're moving a lot of our spend from a debit bin to a credit bin, which obviously has high interchange, and it has dynamics in terms of disputes and chargebacks and things like that, right? So there's a different dynamic and there's a different regulation set for credit. But the way we have built the infrastructure and the product experience, we've managed to sort of mitigate and help some of those products experience for the customer. So what that really does at the top of funnel is enable us to have it 100% eligible, no fee, no APR, no funny business, low charge off, secured charge card, build credit with every swipe for anyone who comes in. And so that's a different product of what's out in the market to even our neobank competitors, but also more importantly, to some of our bank competitors, because they have a very narrow credit box. They're trying to get the graduation, they have high charge offs. It's not a profitable product. It's very hard to deploy in marketing. And so it's just, it's tough. It's obviously tough for the banks to compete with this product. So as you've seen in the press, there's multiple banks coming out saying, regulation changes are coming and that we're going to have to charge for, monthly account fees and we can't do this properly. Well, Current has spent, the best part of 8-9 years building for this moment where we knew these tailwinds or headwinds for everyone else, but tailwinds for us would come in and sort of strategically position us in a very advantageous position from a company standpoint, but more importantly, from a customer standpoint, it is the best option. So that we launched that in June, July last year, which was, you could argue, multiple years of work enabling that product pinnacle. It's like almost like an iceberg, right? It's like everyone says, "Oh, you did that. You'd launched that in 9 months or whatever we did," but really it was building upon like a lot of hard work at the company to get to that point. So that's been very exciting to see that product roll out, build, and also just frankly build credit. It's awesome. I use it myself personally to also being an import and a foreign. It's been very useful for me as well. So that has been great, and a tremendous amount of growth in terms of deposit spend and revenue through that. So that's been good. The strategic thing at the end of 21 into 22 was, at Current at least, we were like, okay, we think CACs will come down over time because they really were very high in the bull market, right? 20% of all VC dollars in fintech. Everyone's a fintech apparently at that point.
Everybody's bidding for the same customers. Yeah.
Everyone's bidding for the same customer, which is why a lot of people went to, tried to do B2B, to C and all this other stuff, which I can go into. We're doing some interesting things in that. But really we were like, okay, CACs have gone so high that there'll be consolidation, there'll be winners and losers, but they're probably not going down all the way to 2018, 2019 levels. And so to get a truly interesting high growth business, you need to increase LTV. And so from a corporate standpoint, we had to find a solution set for our customers, but also sort of helped us on our LTV. And so the build card was really, really helpful on that. So that's sort of step one of our journey. And then as soon as we got that up and running and iterating through most of half of last year, we went straight into the Paycheck Advance product, which is I'm sure yourself and many listeners will be very familiar with this product, which is up to $500 between paychecks. We call it PCA internally. We launched that in October, like I mentioned, internally, and sort of expanded it and sort of learned, right? Now, the interesting thing with the Paycheck Advance Earned Wage Access product is it's not credit. There's no recourse and all that other stuff. And the interesting thing for Current specifically is this is another product. It's not our only product or our only revenue. We're a payments business. 80% of our revenue is from interchange. So we're not sort of leaning on this product like maybe some others are in the public and private markets. And so that enables us to do a few different things. So no dark patterns, no funny business, no gating subscriptions and all this other stuff that you may see in sort of other places. And so no recourse, not credit, but very valuable liquidity for our customers, right? Because you can imagine low credit score out of the sort of credit system in many ways, but you still need access to your paycheck. You're still working. Maybe you're most likely working 2 jobs, right? 25-30% of our customers are working more than 1 job, and that data structure and sort of classification alone is just very hard for other like banks or credit card companies to even get a handle on, right? They're not really doing that. They're just sort of heavily relying on that FICO score, and so there is a increasing massive demographic of America that like jobs have changed, cash flow has changed. And so cash flow underwriting is really, really important, but it's also very complex. And so we're sort of uniquely positioned to really serve these customers in that way. And so we provide really valuable liquidity. Now, liquidity has always been an important part of neobanking, in my view, in America. You can have different views, I think, in different countries, but we've led with 2 days early payroll, affecting off the balance sheet as soon as that hit from the employer, taking employer risk basically, into $200 or up to $200 interest fee-free overdraft, and that was a period of liquidity-led growth in the industry. And now we've married this sort of $500 earned wage access product into the banking, switch your paycheck over very, very neatly for Current, I think. And I think probably top decile growth right now when you look at our Paycheck Advance product really working synergistically with that build card. So that's been busy last year. And so we've been iterating most part of this year and really sort of making sure everything works perfectly, that we have great product experiences, and that the customers are happy, to be honest, that we're solving their problems.
It sounds like you're really leading with product-led growth, right?
Product-led growth. So this is when I talk to potential investors and all the rest of it, obviously the growth will speak for itself. But then you'll always get people sort of going, oh, which channel is this? Which is a fair question, because when you see exceptional growth, you're like, oh, well, they've tapped a channel and like
right.
that'll go away over time. Well, no, we have some of the best competitors in the market in our space and the best funded, very intelligent, smart people. And we're able to grow probably at top decile right now because of the product moat that we have established and will continue to establish, built upon that verticalized tech stack that we've really leaned into. The way to look at Current, I think, is it's a longer term play. It takes longer to get to this point because third parties much easier to stick together. But the market being a long-term weighing machine, I think we win over time, and we're starting to see that come through. That product moat really come through for Current this year.
And the marketing spend, I know, in some of our previous conversations, you had some very high profile like influencers helping to get the word out. How has that evolved over time as you've come out with these new products?
Yeah, I think we've learned a lot. By the way, the influencer world is really still very interesting. Some of the influencers that we had used over the years grew to sort of,
you had the biggest in the industry. Yeah,
exactly. And good for them. Good for that person. Obviously, Mr. Beast was one of them. The dynamic changes when you go international. So we are US based at the moment, right? We have a vision statement that is connect the world financially. And so we would love to go international, but we haven't won America yet. So we're still focused here. And when you look at someone who has just an amazing international reach, you'll see a lot of the CPMs be sort of used for international. And if you can't monetize those CPMs, you cannot get an effective rate that makes sense for both parties, right? And so, I would suggest like large multinational corporations would probably be best suited for the largest YouTube influencer, right? Like a global reach and an amazing reach for a 13 to 30-year-old, right? And so we've naturally grown and both grown, but maybe slightly different ways geographically. And so that's very hard for us to maintain effective CPMs. And that's one aspect of it. The other aspect is we just got a lot better at CAC. Now, I said strategically, we're like, okay, I don't think CACs go down that much. We were pleasantly surprised about the product synergies and how we sort of managed to really stitch everything together. And there's another level beyond that, which is data governance, classification, and really focusing on data as the advantage and the tech advantage. And so very similar to trading my whole life, there's a little bit of like binary, can you get the customer before the next person? And it's binary. If you can do it 5 milliseconds before them, you win, right? And so there's an element of that in how we are growing. And so that has really helped us in this year as well. And so what we're seeing is our CPMs and also our conversions doing very well to what we would classify as a full customer. And so other channels, as you sort of scale and sort of get really good at like a few of the distributive and like diversified, I should say. But you do tend to sort of get sort of spotty in some of these channels. You tend to find other channels are like not as efficient. And so, which is great because it means that as you have scale all the way back up, right? So we've seen that dynamic a little bit. Like we got really good as a company, touch wood. And so I think we have a lot of horsepower left to go back up into like quite very significant growth in this industry.
Awesome. I think I've shared this story with you before, but I'm an American expat living overseas. And a couple years ago, one of the first times I spoke with you, I came back to he was a 14-year-old. My son was about 14 years old then. And I said I was speaking to Stuart Sopp, CEO at Current. And he's like, oh, I know Current, because he was a follower of this influencer. And I was just like, this is not obviously not your target demographic because he's living overseas, as you were saying, but he had brand recall, of your brand based on that impact. And that always just that was a wow moment for me. That was the first time I saw the power of that type of influence.
So it's amazing, actually. Jimmy's reach is insanely good. Brand recall is amazing, best in the business. And I have multiple points of confirmation from many countries that Current is well known in, which would just blow you away. Definitely in Asia and Eurasia, it's absolutely wild. Like totally, in Japan, Korea, Australia, people know the Current brand and have asked when we're coming there. So, we'll see.
International expansion is ready when you're ready. Yeah,
it is. It's ready to go. We have definitely primed the pumps in many, many countries when that's ready.
I want to come back, Stuart, to the build card. At Tearsheet, one of the things we do is we look a lot about what goes into building a good card product. And in the case of the build card, how did you go about differentiating this product? And what were some of the biggest challenges you had to get this product to market and in the hands of consumers?
Yeah. So charge cards, or I should say secure charge cards that build credit builders, have been around for a while, right? Community banks have been building them forever. Money center banks have, most of them, I would say 70% of them have some form of credit builder. So, there's lots of comps out there. We really listen to our customers. And so, you could imagine your sort of 600 or 580 FICO credit score. You need money. You're working 2 jobs. You are a good credit risk, right? You are, but you are just not in that system. And so you can imagine applying for a credit card or a loan or something like that, and you're just getting turned down. So whenever these credit card companies go wide, or personal loan companies, they tend to do pre-approvals and all this other stuff for very good reason. It's because people who really need money are not in that system, or they don't have a high enough credit score. And so you can imagine 90%, when they go wide, 90% of those applications are turned down. And that is a terrible experience for pretty much everyone.
Totally.
It's high for them, and it's a terrible experience for the consumer. And they're just not able to underwrite it in the way that we are, because they don't do all the cash flow underwriting, and not focused on banking services. And so you can imagine current coming up in these third-party marketplaces and all sorts of other places where you're like, and we were like, okay, there's two problems. One is they need to build their credit score, and two is they need access to liquidity. And so when we're ideating sort of 2 years ago for the next stage of current, it's like, okay, we know we need a credit builder. We know we need it to be 100% eligible. How can we make that, right? How can you make 100% eligible credit builder? And also we'd learned from our, I would say, biggest competitor out there on the private markets. They had already had a relatively successful charge card product. So we knew what a path could look like, but also they have potentially, we don't know, but it looks like an attach problem, right? It's like, you first need, because of those infrastructure sort of challenges that you have when you sort of stick everything together, which is, I have two ledgers as a fintech. I've got these two issuing banks. I got two, Reg Z, all these different regulations for disputes, etc., and holding money, and that level of complexity of moving those two together means that more often than not, you're going to get a neobank, a fintech, just saying, okay, look, these are two separate products, two separate teams. You're going to have to move money over here. We'll create that eligibility criteria to keep the chargebacks low, and we'll, and it will be an ARPU expansion on the business. We took a fundamentally different view. We were like, we want this to be the engine. We want everyone in America who is eligible, which should be everyone who's a real person, to be able to have a secure charge card. And so when you take that kind of brazen stance, okay, what is the art of possible? You start like, we're going to Trevor, the CTO co-founder. It's like, okay, how do we create this? And so we worked out how to do it. And then it was like, how do we get the attach rates as high as possible? Because there's also challenges on the network and the categories, the MCCs, because there's different rule sets, like I've sort of mentioned. And so, for example, if you were to, like a Visa Plus, right, doesn't work on credit cards. You can't move money. You have to move money on debit. There are certain categories like gambling, certain porn sites, or whatever it is, adult sites, that don't work on credit cards. They won't be accepted. So due to that profile of charge-offs and losing money, et cetera, and they're only on debit. And so from a customer experience, you still can't quite displace debit with credit. And that's fine, right? That's fine. But for the majority of the use cases, we were like, okay, and also there's probably some positive selection bias when you get someone who wants to build their credit. So that's also good. And so it was marrying these two experiences together. And so there was a back end thing and there was a top end thing from a product experience, and it was all mashed in the middle. Obviously, current, we hired some great people and managed to sort of overcome some significant challenges in that. And we also worked, I should call out, very closely with Visa. These are very, very helpful in this product. And so, we were there with them for best part of a year, ideating on how to get this product over the line.
That's super impressive. I want to talk about the other product you mentioned as well, your Paycheck Advance, the EWA product that you guys launched. Why now for that product? And again, it may be a similar question. How do you differentiate that against a lot of the other products in the market?
Yeah, why now is a good question, really, because I was also, I'll be completely candid, very skeptical of the earned wage access space.
Well, it's good that you were skeptical and you went along with it also. So I'm curious how that happens. Yeah,
I think we're reasonable people here too, right? So we there was
a hypothesis.
Yeah. There's a lot of in the past it has been tarred with sort of payday lending, which is a sort of pejorative term, and the 1,000% APRs and all that other stuff, right? And so for good, and also like those physically sort of gross stores that you pass, you're like, well, come on, it's like that. And so this whole industry, I think, has a bad rap. But why does it exist? Is the right question to ask, right? Which is these are people who are working hard, who need access to liquidity, and the tool set that banks and credit card companies and lending have just doesn't work very well sub 600 or 620. It has to go from credit and credibility and that trust element to cash flow underwriting and understanding the heartbeat of the flow of money in and out, what they're spending on and things like that. It just has to do that. And then in terms of a product sort of strategy and ideation, it's like there's sort of more affluent customers you can have all these verticals and they're sort of separate and people can pick and choose and you cross sell. And that's what banks are really good at in financial platforms up in the higher end. But when it comes to sort of a less affluent customer, there is less demand for like a lot of these products and services because they're really focused on, hand to mouth sort of feed, living and trying to get money and gas and all the rest of it. And so what you see in the product construct is conflation, right? And so they need to work, there's elements of them, but they're not maybe standalone products, and they need to work very clever, very synergistically and quickly. And the money movement has to be quick and very clearly communicated to the customer. And so that's like a sort of almost a product construct and an ethos that you have to do. Money has to move quick, has to be clear and clearly communicated, and that you still need access to some of these products, but in a lighter, simplified way. Mm-hmm. And so when it came to earned wage access, our PCA product, I was sort of put off by the industry a little bit until about a year and a half, 2 years ago, it was still in the bull market, to be honest, in 21. And you started to see a shift in regulatory and compliance, right? So regulation, mm-hmm. We started to see, in the federal system talking more positively about it. It's like, okay, what we should probably do is regulate, get licensing by states. And you're starting to see now some of those, we actually have
state by state clarifying what their stance is. Yeah,
exactly. And I think what is happening, and we applied for obviously these licenses state by state, and some states are still not there, right? Some states mm-hmm. are like, look, we don't like it, we don't want to do it, and that's fine. We will not have active users in those states. We will not market all those things. But I think what is happening and what will happen over the next 3 to 5 years is very similar to like lending licenses state by state. It's just going to be lending licenses for people 600, 620 and above. EWA licensing 600 below, right? I think that's the product mm-hmm. market. This will be as big as credit cards, in my view, and lending in that sense. And so that's exciting. So I was like, okay, we're getting clarity from regulators. I think from a technology and product experience, we can do it in a cheaper, faster, more effective way that isn't reliant on some of these things that I'd already mentioned, like, hey, gating that's dark patterned, you never cancel it and all this stuff. We didn't want to do that, obviously. And so because we have the banking tail, we make more than enough if we can get you as a primary user, which is a payrolling user of one of your paychecks. That's more than enough for us for an RRP and LTV. And so basically, it was time. As a company, we were ready. As a regulation and compliance sort of mm-hmm. angle, I think it's time now. It's ready. And then I think the market, from a macro point of view, I mean, inflation is insane still, and it's not going down, right? I mean, from a rate of change, it's gone down, sure. From an absolute price point, we're up 25, 30% on staple goods. And so people, and we have full employment, right? So I think that there's a lot of pressure on like middle class all the way down, right? It's like there's a lot of pressure on the household. And so this product is just at the right time for the populace as well.
Your experience as a macro trader always shines through in our conversations together. So I want you to keep your macro trader hat on. And one of the things that we've seen through this like gauntlet of a market is some good news also. Like, there are some of the bigger fintechs are gearing up. It seems to be to go IPO. Which I think brings a lot of clarity and maybe some optimism to the market. I'm kind of curious how you're seeing that play out, and in particular, how that might impact a company like Current.
Yeah, looking forward to these IPOs personally, and I'm sure a lot of people in Current are as well. I think IPOs in any sector are great, and we mention the names if you want, but we're looking forward to seeing them do well and like get over the line. So that'll be good for everyone, lifts all boats when a frenemy or a competitor, as Trevor would call them, do well. And so I think the market is in the process and has picked winners through a bubble. You see these bubbles, and it happens every time, right? Clearly, fintech and tech in general, because of Zerp, was in like the bubble of bubbles, and so what you see from that is it's much harder to get funding from this point on, because the market rightly and I think fairly says, hey, we did it, and so who's doing what from this point on. So I think you can.
But the validation bar has risen, essentially.
Yeah, absolutely, and I think rightly so. I think. Well, I mean, I could argue my other side of it, which is you hear a lot in the public or the Twitter sphere, whatever we're calling it now, in fintech, which is like, yes, a lot of money's gone in. When is the change coming? Right? There's sort of this, hey, we want to see like banking change forever, and we want it now. And I'm like, yes, that's important. But on the other hand, we look at the Bass situation and like people breaking rules and trying to make things happen. And then we complain about that, right? Rightly. And so there's this thing, I think, in healthcare, in fintech specifically, or banking, whatever, banking services, you just, it's slower than you want it. It's definitely slower than all investors and the public want it to be.
Move slowly and don't break anything.
Move slowly and don't break things. And so what you're seeing, this is what I mean. So I don't think, as long as it's moving in the right direction, right? And I think it is. Like some of these products and these services, you look at our, customer feedback, you look at the customer rate of growth, it's phenomenal. And so we've been very deliberate about who we're servicing right now. And so a lot of our customers are not in, commentating on fintech in general, right? They're just trying to live a normal life. So maybe there's a bubble outside of the feedback loop there that needs to be tapped into a little bit. But yeah, I think there is great progress happening. IPOs are coming to market. Winners are being selected. And I think you can gain real confidence from some sort of international names, right? So you look at Revolut, doing really well, gone multinational. They've solved a problem mainly in Europe. You look at neobank, solved the South American problem really well. Amazing penetration in terms of like their TAM and also ARPUs and all the rest of it. And so America needs a winner or winners. And so we still think it's up for grabs, and it's a harder problem set to solve, but once it's solved, it's going to be very powerful.
Awesome. So with that IPO calendar shaping up in the background, I'm curious, as we look forward, maybe in the next 6 months, next year, like what does your roadmap look like? Where are you leading the company?
Yeah. So we're focused on really iterating on these two products. So, launched within the last year, basically, right? Yeah. Within a year, within 12 months. So there's still all that going on, which is a decent amount of work, making sure that, the expected behavior is the forecasted behavior is the actual behavior of what you want to see into the business. And it is so far. And that has been phenomenal. Well, as we go forward into the rest of this year, into next year, we are focused on profitability, just like everyone else. And so
unit economics,
yeah. You don't get there without those first. And so our unit economics are great and getting better. And so they will continue because of our product moat and being able to do all these things. And so we're focused on, I've said this in a few conferences over the years. I said that the deposit wars are largely kind of done in that sense, right? That was like the low hanging fruit. And then the really complex thing is the liquidity, credit, lending side of things done safely. The great thing about EWA is you have very fast paybacks. And so you learn very quickly. In a credit card company, it takes 10 years to get like amazing data, right? And so
vintages, right? You don't have that in you, do you?
Yeah, that's right. You got it. So you got like 18 months of vintage, and you got to see a couple of bubbles, a couple of cycles. And then you're like, okay, I'm a real credit card company, right? It's a really long time because those 18 month sort of cycles. For us, we have 2-week cycles. And so we've already had the equivalents of 10 or 15 years of credit card data equivalents. And so we're able to learn very, very quickly. So our underwriting team, all the teams, product teams are learning very quickly. So we like that. And so that enables us to be stronger and on the front foot going into the things that would be capital intensive, harder to do longer term. So more traditional lending, installment loans, things like that are and also clever sort of ways of looking at liquidity for products and services that are typically gated against people that need large premiums or deposits, right? And so you could imagine there's a lot of things out there without giving everything away. So we're focused on those over the next 12 months. Those will be ARPU expansions as well as going into new customer segments, although we don't really need to at this point. Mm-hmm. We're more than happy at our growth rate of close to 100% a year, just chugging along. So we're doing all right.
Stuart, always great to talk to you. Thanks for joining us on Tearsheet Podcast today.
Thanks, Zach.